It's a pleasure to have with us John Gilbert, the Chief Investment Officer at General Re, New England Asset Management. John, welcome.
Thank you.
It's a pleasure to have you on our program. I'd love to hear about how you're making sense of today's investing environment, how to preserve purchasing power over time, nominal versus real returns, and some of the challenges that and opportunities in the current macroeconomic environment. Before we do that, perhaps you could tell us a bit about your firm and a bit about your background.
Sure. Well, thank you. It's a pleasure to be here. Our firm manages about $70 billion of unaffiliated assets. Most of that is fixed income. Our clients are almost entirely insurance companies. So there's a heavy emphasis on risk control. They are highly regulated and subject to ratings agency scrutiny, and tend to have an almost a congenital preference for higher quality investments and certainly principal preservation, which makes the current environment particularly challenging for them and therefore for us. Very briefly, I have been in the investment business for over 30 years. I've been in the markets personally for 35 or 40. I've worked for a couple of firms, and I am Chief Investment Officer of our firm, and I've been there for about 25 years.
Please tell us then, from your perspective, where do you see the main challenges and opportunities when it comes to dealing with investment opportunity, but also with risk and the risk of capital loss?
Well, our view, to make a very complicated subject perhaps more simple than it deserves to be, is that the financial crisis paradoxically raised risk levels rather than clarifying anything, confused investors rather than clarifying things. Oftentimes, crises serve as the sort of paroxysm that clears the air somehow and induces policymakers to take action that clarify how things will be handled in the future. The 2008-2009 global financial crisis had the opposite effect. There was no plan for the government acting as lender of last resort, and so you had the very haphazard approach when house prices started to roll. The Bear Stearns hedge funds got in trouble in the summer of 2007, that appeared to culminate in Bear Stearns, the Bear Stearns crisis in March of 2008. And the government employed the fairly conventional lender of last resort in orchestrating the Bear Stearns takeover by Morgan with the Maiden Lane deals. And in fact, the Federal Reserve, in their description of Maiden Lane 1, specifically invokes the section of the Federal Reserve Act that allows them to act in unusual and exigent circumstances, as the legislation says, in lending to private borrowers. And that was fairly conventional lender of last resort behavior. So far as that went, it appeared that government was following the script. And a side note here, the script is almost 200 years old. The development of lender of last resort doctrine really began in London with the Bank of England in the 19th century. And financial historians look at the financial crisis in London of 1825 as a seminal development, because it was the first time, the first real financial crisis after the Industrial Revolution in England, and the first time that a bank clearly acted as lender of last resort to keep the financial system solvent. And that was a lot of the thinking about that continued to develop through the 19th century. It was captured in a book called Lombard Street by Walter Bagehot in 1873, I believe it was. And this script, if you will, pretty much held until September of 2008, when the crisis became so severe and the public distrust of the financial system in the United States reached a crescendo, that because presumably of concerns about moral hazard, Lehman was allowed to fail. And that was a seminal event. We think that will be appreciated more as time goes on rather than less, as an event that really changed financial system behavior and attitudes toward risk. And specifically, the problem that the government has now is inducing people to take risk when they've learned that government behavior can be unpredictable and unreliable. And so inducing people to make risky investments, and by risky investments I don't mean investments far out on the surfboard, I mean typical private sector investment kind of decisions, corporate investment and so forth. Inducing them to do that when they've learned that there may not be a lender of last resort when things go wrong means that people are likely to employ less leverage, higher precautionary balances, and self-insure, essentially in insurance terms. And we think that that's a change that's going to persist for some time. So our guess is that that the bear market in stocks is not over, and that until this repricing of risk is complete, that stocks will continue to struggle, both in nominal and real terms, and we'll continue to have a world of lower returns and at times considerable volatility, much more so than we're accustomed to. The paradox is that while we have this challenging environment for stocks in both nominal and real terms, certainly risk adjusted, we have two secular price increases underway, two secular bull markets underway, one in bonds and one in gold, precious metals. Those make very odd traveling companions and probably unsustainable traveling companions. One can make a case that stocks and bonds should travel together, which they did for the 20 years starting with Paul Volcker. You can even make a case that stocks and gold can travel together for a period of time, as we've just seen in Europe with the lifting of the fears of a deflationary policy mistake in Europe. But for bonds and gold to be traveling together, it's a very strange combination and implies that the world has something going on that's simply unsustainable. One of those has to be wrong. And so our challenge in managing money for insurance companies is how to deal with the disappearance of nominal yield, let alone real yield, and at the same time control risk, because the temptations to do the wrong thing are increasingly powerful. In fact, in some cases, they're overwhelming. So we see people going out the risk spectrum relative to what they used to be comfortable with. Individual particular clients whose preferences, for whom we've managed money for years, whose preferences we understand pretty well from having known them for some time, are going out the risk spectrum out of desperation, out of desperation simply to continue to try to generate the same net investment income, let alone more, in an environment where their portfolios are running off. The central lesson of government behavior is unintended consequences, and the stronger the government behavior, the greater the likelihood of significant unintended consequences. The expansion of central bank balance sheets has been, obviously, as everybody knows, so great that the likelihood of significant unintended consequences over the next several years are very high. Forecasting exactly what they're going to be, I think you can call them in shape, but the specific locus of them and when they occur is a tougher call. We're still in the development stages of it, but we see some signs of people reaching for return already, and we know how that ends. So our job is to try to manage the conflicting objectives of the near-term demand for return with keeping an eye on the horizon for where the next mistakes are going to be made, because they're already in process.
When it comes to Europe and the crisis there, there's a lot of noise around it. How do you look at that, and where do you see the causes, the implications of, and as well, how do you position your portfolios to mitigate risk of capital loss and ensure that you can have enough real return to keep up with the liability side?
The endemic problem that we have in the developed world is that you had debt buildups in many countries at the same time. So we've had, it's not unusual to look over the last few decades at financial episodes. People often look at the Scandinavian episode of the early 1990s and so forth. These breakouts in credit creation happen from time to time. They virtually always end the same way, which is badly. But when they're limited in locale, in extent, or both, they're manageable. The way that the Scandinavian countries got out of it relatively painlessly and apparently fairly skillfully included not only the fact that they managed the situation rather well themselves, but they were doing so in a world that was growing fairly rapidly. When you have everybody in the same trouble at the same time, it's much more difficult to get out of this, and the time horizon is going to be much greater. The stress is so great in Europe because on top of the issues that necessarily follow excessive debt accumulation, they have a deflationary force that other people don't have, and that is a fixed currency regime. So the euro can be thought of as the first experiment in a fixed monetary standard since the gold standard. And we know what happened to the gold standard under stress in the 1930s. It was thrown over the side by different countries at different rates. But as Bernanke himself has written about, the sooner they threw out the gold standard, the sooner they started to recover from the Depression. The same deflationary pressure is at work in Europe now, not only because of the debt buildup, but because when they joined monetary union, they gave up the ability to do what countries invariably do to get out of this problem, which is to devalue. They gave up the ability to do that. And so the stress in Europe is all the greater because of the fixity of monetary union. So how do you get out of that? We have been very skeptical at all of the measures that the European policymakers have taken so far, and remain skeptical. It's very well understood now that monetary union without fiscal union doesn't work. Many people have anticipated for some time that would eventually be a problem. We are now there. The rate at which they move to some sort of joint and several liability, mutualization of risk, both at the fiscal level and in the banking system, is going to determine how that works out, and is going to determine whether the Eurozone ends up as 17 countries and whether it's the same 17 that we have now. There are theories about whether Greece leaves, how they leave, whether a Greek exit allows Germany to whether that's the quid pro quo to get Germany to the table in terms of joint and several liability, having essentially kicked out the worst actor under the Stability and Growth Pact. So forecasting how this is going to work out, we think is virtually impossible. But the current situation is unsustainable, and that includes large purchases of bonds by the ECB, because that is a stopgap measure, as is well understood, deals with liquidity but not solvency. Solvency problem remains, as does the underlying problem of differences in unit labor costs. And in some cases, those are still getting worse. So the problem, we are still some distance from the solution. We have thought that as crises develop, they accelerate in speed, and it is felt to us through the middle of this year that was underway. That's what was occurring, and we still think that's true. We think we are closer to what we've referred to as a deflationary thunderclap that has the effect of forcing the policymakers, the Germans being the most important, to do something. And our best guess remains that that is the outlook, that pretty soon we're going to get. If the ECB's recent statement about buying bonds notwithstanding, doesn't solve the basic issues. And so if the markets figure that out, and what we're seeing is that these central bank moves in Europe and elsewhere have diminishing returns over time. As the markets figure that out, we may see further pressure on those bond markets, unless they really do something to fix the underlying fiscal issues.
But isn't it interesting, and you talked about this paradox that US and Japan look like, in your words, the C students, and yet they have the lower bond yields than you would see some of the European countries. And can you give us a sense for what that really entails and what perhaps it will lead to?
When I wrote about C students in the US and Japan, I was referring to fiscal fundamentals and debt loads. And if you simply array fiscal fundamentals and debt loads against bond yields, the picture makes no sense. The reason for that is the currency regime. They can borrow in their own currencies. And a country that can borrow in its own currency has no, at least so far as we can see at this point, no foreseeable credit risk. If you define credit risk as the likelihood of timely payment of principal and interest, because they can simply print it, and obviously this is what they're doing. Whereas the Europeans have given that up. So the European countries that may have better fiscal fundamentals are trading at much higher yields because they don't have that ability to devalue. And the ability to devalue your way out of trouble is the time-honored approach to this. So that really is dispositive, we think, and it's again why the resolution of the Eurozone issue is such an urgent problem, because those countries are the ones who don't have that.
So in a sense, is that then what offers the potential out of the situation, this ability to print money, essentially? Is that, in your view, then where we're ultimately headed?
Well, it is. I mean, we're already doing that. So the key question is we've created these oceans of bank reserves with, call it quantitative easing or whatever it's called in whatever country you're in. Massive expansions in the central bank balance sheet resulting in massive increases in bank reserves, banks' deposits at the central bank. And of course, in the world, the pre-crisis world, the idea was that increases in bank reserves would be employed through the fractional reserve banking system to banks would make loans, credit the new borrower with a demand deposit, which would then be spent, and that was how money supply increased. That credit multiplier isn't working at the moment. So the big question underlying the central bank behavior today is, at some point, will that credit multiplier re-engage? There aren't a lot of signs of it yet. There are a few at the margin, perhaps. But if you really want to formulate the bear case for risk assets and for stocks in particular, it's that the credit multiplier does re-engage. A lot of people would celebrate it as being a sign of economic growth returning. But if it does, and it becomes a constraint on on central banks' ability to continue to do large stimulative programs, even more unconventional perhaps than QE, to the extent that they start to be constrained by credit creation before all of these debt effects have been worked out, then risk assets under those circumstances could do poorly. We're clearly not there yet. But the current situation is so urgent politically that we may see even more unconventional policies before we're finished that then cause the credit multiplier to re-engage.
So let's look at this from the perspective of an investor, an insurance company that has the liability side of the balance sheet and is perhaps constrained in where it can invest. You talked about the perceived safety of U.S. Assets because of the low credit risk and due to the ability of the U.S. central bank to print money. What is then the challenge for these types of investors, and how do you deal with that?
Their behavior is well, it varies a great deal by firm, as it inevitably will. We see it. One of the reasons to think that some of this is getting rather long in the tooth, and that we may be closer to a change in behavior, is that at the same time that we're seeing some people going out the risk spectrum, high yield, for example, high yield bonds are quite fashionable. Clearly dividend yield stocks, everybody's figured that out to the point where they are getting expensive, actually. We have been in those for a while. We're taking a hard look at some of them because their prices are just excessive. At the same time, we have the flight to safety going on with very large quantities of assets. So while certain people at the margin may be adding to risky assets that they might not have historically purchased, people, for example, buying common stocks who were only fixed income investors before, just to get the yield on electric utility stocks, for example. The larger trend is the flight to safety, to the point where safe assets, or believed to be safe assets, are clearly overvalued. I mean, the highest quality bonds assure you of negative real yields. The 10-year U.S. Treasury yields 1.5, and the Fed's inflation target is 2. So you are entombed in 50 basis points of negative real yield for a decade. That's an unattractively valued asset, and that must change. So I think the question is whether it changes quietly or painfully, but the behavior of investors under these circumstances depends to some extent on their flexibility and on their risk tolerances, and the flight to safety is getting overdone. I've just written on the subject of France, and in our opinion, France is significantly overvalued. France is trading today on the 10-year somewhere between 2 and 2.25. Even after Draghi spoke recently, Italy and Spain are 6 or 6.5. Germany is something under 1.5. So France is trading much closer to Germany than it is to Italy and Spain. It probably, on the fiscal fundamentals, should be about halfway. France should be trading over 4% on these circumstances, and yet it's trading at half of that. So if I were running a credit hedge fund, I would be short France. Those are the kind of anomalies that we're now seeing. And the reason is simple. There isn't enough room in the German market to take all the money that's fleeing the risk venues. So there's not enough of the people who are reaching for yield to compensate for the flight to safety. And so we're seeing some of the real anomalies so far in the flight to safety, actually.
Can we just go back to basics, and if you could give us some sense of the then way to match the assets to the liabilities of an insurance company, and perhaps talk about some of the regulatory restrictions to give us a sense and to help us appreciate the challenge that these types of investors are faced with.
One of the pieces of our business is what we call enterprise risk management, which involves a lot of optimization modeling and starts with an analysis of the firm's liabilities. What lines of business do they write? How volatile are they? What are their underwriting results over time? Any changes that may be going on in there? And then that pollinates selection among asset classes, broad asset classes, and even getting more granular in terms of maturity and credit profile. Another important part, in addition to the volatility of their liabilities, is the duration of their liabilities. liabilities. So property casualty companies, for example, typically have significantly shorter liabilities than life companies do. That will also drive asset selection. So as I mentioned before, the regulatory and rating scrutiny that they find themselves under is intense, and that ERM work that we do often becomes an important part of their response to regulators and ratings agencies, so that they can show regulators and ratings agencies that they understand this, that they've quantified it, and that given the assumptions about underwriting results and liabilities, that the asset mix makes some sense. So there is flexibility in their choices of assets, but it has a lot of constraints on it imposed by the nature of the businesses that they're in.
So does that then speak to the returns and the risks associated with insurance operating results that are then inextricably linked to the investment results?
The answer clearly is yes, and it's why the typical fixed income insurance portfolio is a so-called core portfolio, which is high grade investment grade bonds. There is some flexibility in how they can move around in there. There is some flexibility at the margin with buying high yield, low investment grade bank loans, other things that may have a little more yield to them. And there's flexibility in more volatile investments as well, such as equities and other sort of alternative asset classes that over time have higher returns, certainly in this environment, than fixed income, high grade fixed income. There's some flexibility, but it tends to be flexibility at the margin. In other words, you are not going to see anything but an insurance company that writes a small amount of insurance relative to their capital, putting large amounts of money, large amounts of their capital into stocks or high yield or something like that. The scrutiny that they're under, the constraints on their behavior are such that it's a relatively narrow corridor of risk that they have to operate within.
But help us understand this then, because it sort of reminds me of what David Swensen went through with the U.S. endowments a long time ago, and recognized that danger of being fixed income instruments for an endowment. In today's environment, then, in a way, insurance companies, especially, let's say on the life side, with long-term, long-duration liabilities, shouldn't they be much more in equities? And this concept of risk, how it's defined by the regulator, and how we know it in the real world, shouldn't there even be a much bigger change, a sea change in the way these types of investors invest their assets?
Well, the typical insurance company operates in a very different world from Yale University. Yale has a number of things going for it. One is a very large endowment. Another is the fact that they have no fixed liabilities against that endowment. They clearly have high executory costs. I live fairly close to New Haven myself, and my wife is quite fond of going out to dinner over there, and Yale has a large and expensive infrastructure, so clearly there are executory costs. But they don't have legal liabilities against that endowment. And they can take a very long-term horizon as a result. They also have well-paid alumni who like to contribute to them and replenish the endowment over time. So what they were able to do was recognize, and it was a very wise decision. They recognized that they had that flexibility and could undertake alternative assets in much larger allocations than conventional think at the time typically subscribed to, and it worked very well for them. But they were able to do it because of the of the position that they were in, which was an enviable position, frankly, and they were smart to take advantage of. The typical insurance company has contractual liabilities, either stated or contingent, against their assets. They have much shorter measurement periods and much greater regulatory scrutiny than Yale does. Yale has to respond to their board of trustees, whereas the typical insurance company has the state insurance commissioner, the ratings agency AM Best, and all kinds of people looking over their shoulders on a fairly regular basis. Our clients meet with those people on a regular basis, because ultimately the question is policyholder safety. Ultimately the question is, will they be around to pay their stated or contingent claims when they come due? And in the case of the contingent claims, you never know when it's going to happen, which is the case for a lot of insurance liabilities. So there's not only a need for solvency, but a need for liquidity as well. So all of these constraints put them in a very different position. Now, having said all of that, there are insurance companies that are sort of Yale-like in certain ways because they have a lot of capital. And if you follow the insurance industry, you know who some of them are. They have put themselves in the position, generally deliberately, of having the capital to own larger allocations to equities and so forth. I have one client that has had 50% of their money in equities. For an insurance company, that's very unusual, but that's because the amount of insurance that they wrote relative to their capital was lower than is typical. And they also had a culture of understanding how to manage the volatility in that and manage the regulatory and ratings agency response to that. So they had a long track record of successfully investing in equities. In general, most ratings agencies have scrutiny is an important part of their lives, and so they are reluctant to take on too much risk.
For investors who are looking at insurance companies, let's say the publicly listed ones in Europe as an example, do you think some of these constraints then, regulatory, for example, against this backdrop that you've described, in terms of the low, of course, the low, record low interest rates on the asset side, does that explain then the valuations of some of these companies? Could you please, could you in a way help us understand what are then some of the risks for investors into, equity investors into insurance companies? There seems to be this fear that they're, first of all, a black box, and then second of all, well, how will they deal with this environment effectively? And can they even deal with it?
Some better than others in dealing with it. The valuations, the insurance business is a structurally challenging business. First of all, in most lines of business, there are virtually no barriers to entry. Sustainable competitive advantage is very tough to come by in a lot of parts of the insurance business. One of the effects of that is that not only does your established competitive set do battle, driving down returns to the cost of capital or below, but one of the phenomena that has arisen in certain segments of the insurance industry is substantial capital entry, as private equity, for example, has formed many insurance companies to come in at the margin. And whenever price has risen, we see this particularly in property casualty, whenever price rises to the point where marginal return on capital is attractive, there's enough capital entry to drive prices back down within 1 or 2 renewal seasons. So it's a structurally challenged business. When you look at the valuations of insurance companies, that's the reason. It does not mean that individual firms cannot excel, and some do. There are firms that have excellent underwriting results. And in this environment, actually, we should be seeing upward pressure on price in the prices of insurance policies. In some cases, we do see that because the days of being able to write at an underwriting loss and make it up on net investment income are over. So under those circumstances, to even earn your cost of capital, you cannot run the underwriting losses that you've run in the past. So there should be pressure for better underwriting results. We are seeing some of that, but it doesn't deal with the basic problem of this being a challenging business because there are a few barriers, if any barriers, to entry in certain lines. In some there are, and you'll see better returns in the companies that have some barriers to competition. But it's too easy for competitive entry to occur in a lot of lines of business. So when you look at valuations, that's basically what you're looking at.
So if you would look at how to evaluate these businesses, what are the key criteria you would be looking for to understand the risks and potential rewards of an insurance company?
Competitive advantage. Any business we look at, we're looking for competitive advantage. As I said, it's harder to come by in commodity businesses. I mean, that's the definition of a commodity business, lack of competitive advantage and competitive distinction. But it can happen. It may simply be, there are certain areas such as where you have a business where a company can have an advantage in its expense structure. So for example, in the direct writers in private passenger automobile have had some ability to lever their factory costs, basically their expenses, and get an advantage given their direct distribution cost advantage. They can have some persistent competitive advantage over time. Generally, though, in most segments, what dominates is the volatility of the loss experience, and so it's tougher to get a consistent competitive advantage on that basis. The only way that companies can really win over time is management and culture, is the willingness to walk away. One of the keys to success in the insurance business is knowing when to say no. That is true in lots of venues in life. It's certainly true in investing, and it's just as true in insurance. There are a lot of parallels between investing and insurance, and the willingness and ability to say no at the wrong price is crucial.
When it comes to the balance sheet of companies, what would you look for there in terms of their liabilities or assets? What would be, for example, better? What would be worse from the perspective of an equity investor?
Well, everything depends on what kind of business they write. So if you have a very well capitalized business that writes what they refer to as low severity business, they can clearly take more risk on the asset side. If, on the other hand, you have a reinsurance company that's writing catastrophe risk, then you have to be fairly controlled about the amount of risk that you take on the asset side because you have a potentially high severity liability exposure. So you have to wonder about both solvency and liquidity under those circumstances, and the risk corridor in which they can operate is lower. They should be able to earn an underwriting profit under those circumstances because that's where if their asset structure is that constrained, they need to be able to make it on the liability side, on the underwriting side. And then it's a question of what's their track record and what do you think of the management.
Now, at your firm, you've stated that, and that applies to your customers as well, the objective of any insurance company really should be on the investment management side to maximize the long-term after-tax total return. And based on what we have discussed in the backdrop in today's environment, can you walk us through what do you do to achieve that?
Well, within all of the constraints that we've talked about, which are considerable, what we're trying to do is find an edge. Unfortunately, everybody else is trying to find an edge too, meaning an edge on us. So we have to try to be. I think the question has to be time horizon, and just as a management in writing insurance has to be able to say no, so that they're around with ample capital to say yes at the right time, the task for their investment manager, internal or external, is exactly the same. What you don't want to do is the classic investment mistake, which is to chase what everybody else is doing. In this environment, the pressure to do so is growing. What we are doing at the margin is to, for clients who are interested in adding a higher yielding investments to their portfolios, we're doing that, but we're doing it in a very risk controlled way, and with careful conversations with them going in about what their risk tolerance is, doing the enterprise risk modeling that I talked about to define how much they can take and work with them on just what the risk tolerance should be given their liabilities. So there's no easy answer to that. Again, for two firms, the specific answers to that question can be very different depending upon what kind of business that they write on the liability side. The common denominator is modeling them and then seeing what alternatives one can pollinate the optimization with to stay within their tolerance of risk.
And understanding that the types of the insurance business you're in determine in a significant way what you're doing on the asset side. In the same token, based on your customers worldwide, do you see any differences in behavior in US-based insurers versus European-based insurers? Are there any different behaviors there?
If our guys from Dublin were here, I think they could answer that. But we have an operation in Dublin that does write for or manage money for some European firms, particularly London firms. So we have a number of clients at Lloyd's. Because of the nature of Lloyd's and the syndicates, the answer, broadly speaking, would be pretty much the same, which is that to the extent that they write different kinds of business, then their asset choices are going to be framed to an important degree by that. The big European, there are, as you know, some very large European insurance companies, and their general choices are going to be very much down the middle of the fairway, making some fine tuning at the margin. Beyond that, I'm not close enough to some of those specific portfolios to say.
Now, we can switch gears and talk a little bit about your firm, and certainly General Re's been under Berkshire for some time now, I think since '98.
Mm-hmm.
Can you talk a little bit about the culture? Then you talked about the importance of management and culture, and in this business, perhaps what do you do differently, and how that allows you to gain that competitive edge?
Well, we manage some of the foreign affiliates for Berkshire and oversee certain of their U.S. assets. The equities are managed from Omaha, as you may imagine. I think in terms of culture, we were acquired by New England Asset Management was acquired by General Re in 1995, which, as you say, was acquired 3 years later by Berkshire. And it's our view of Berkshire is really through Gen Re. I mean, we have the public information on Berkshire. We know it's in the portfolios as well, but it is a very tightly risk-controlled culture. If you looked at what Gen Re was doing before the Berkshire acquisition and what they have done since, they have very much adopted the Berkshire Hathaway attitude toward risk. When to say no is the key issue, and then you wait for the opportunity to say yes. And for the reasons that we talked about, the insurance industry doesn't seem to serve those up as frequently as you might like. But they have really had very good underwriting results. They have, Gen Re was a legacy company, but because of the pressures in the insurance industry, they had some issues. Those issues were worked out under Berkshire, and they've really done a very good job. They have some lines that are really quite profitable. So I think Warren is happy with their underwriting results these days. That's public information, but they just really they, you know, Warren and Ted Montrose and John Trunloki really, you know, they do what they say they do, and it shows in the numbers. They know when to say no, and that's a substantial portion of the time. So they think about insurance the same way we think about investing. It's saying no when it's time to say no is the way that you win over time.
What advice do you have based on your unique perspective sitting within an insurance business to equity investors into insurance companies? What is perhaps the biggest mistake they make?
Well, the biggest mistake, I think, if you look over, it's going to vary by cycle. The biggest mistake over a long period of time is chasing growth, because it's a business that doesn't have a whole lot of that. And so, as in the banking business, the guy who's growing rapidly is probably doing something wrong. I mean, I sound like a hard-bitten cynic when I say that, but we know from credit extension and we know from the insurance businesses, anybody who is outgrowing the business either has a true competitive advantage, and we talked about one or two examples where there is true competitive advantage. Those companies will grow faster than their competitors over time, but any company that's really growing rapidly, in absolute terms, not just in relative terms, but in absolute terms, is throwing up danger signals, because it is a business where it's unlikely that they really have the competitive advantage that their growth rates might suggest. So if I had to say, you know, if you look back at both property casualty companies and life companies, my experience looking at them over a long period of time is that know the management, know the culture, and be circumspect about a rapid growth story, because they in any business, I mean, one of the problems, I mean, there are two things that are tough about the insurance business: no barriers to entry, and the fact that you don't know the price of the cost of the product when you set the price. It's the same as the banking business. In any business where you don't know the cost when you set the price, you have to be very careful, and again, not to beat it to death, but know when to say no. And a company that's growing too rapidly isn't saying no often enough, in all probability.
Now, we've seen people like David Einhorn with Greenlight Re and entered that business. And are there any, from where you sit, what sort of are some of the perhaps insights from these types of investors, and more generally for any insurance company, what can they learn from these sorts of entities and how they take the risks and how they invest the assets, especially?
Well, they've figured out what Warren Buffett figured out. He was obviously a professional investor, not an insurance person by background, and figured out that if you had some secret sauce that allowed you to write at an underwriting profit, that then you not only got the underwriting profit, but you got the float, which you could then invest in whatever, presumably equities, to an important degree or more. So done right, it's a money machine because you have a negative cost of leverage if you're running an underwriting profit. So I think, Warren's not the first guy to have done it. He was early, and I think a lot of people have taken a page from that book. This is actually one of the issues for sustainable insurance profitability. The entry like this. It's not just the private equity guys. It's people like this who are smart people who figured out that a negative cost of carry is kind of the invention of the wheel. If you can pull it off. In terms of what the insurance industry has learned from that, I think what they've learned from it is yet more competition. It's just in a business where you don't have a lot of competitive barriers, smart people are going to figure it out. And it just makes the environment more competitive.
I guess these entities are also regulated and they also operate under these constraints that we talked about earlier. So that's really what I meant. What are they doing differently in the same regulatory environment that some of these other companies are perhaps not doing?
I can't comment on Greenlight. I don't know their insurance lines, but we have clients who've been funded by private equity. There's a limit to how much they can do differently because they're under the same scrutiny as anybody else. So they have insurance commissioners to deal with, and they have ratings agencies to deal with, and so they have to operate within the same constraints, and they're expected to have the same sort of enterprise risk analysis that anybody else is. The way that they might be differentiated, in my experience, is that because they have private equity people behind them, they tend to have a more active interest in more aggressive investments at the margin. So they might have more of an interest in high yield, for example, than the conventional insurance, the management with an insurance background. But it's constrained by their how much insurance premium they write relative to their capital, and all the other factors that we've talked about. So to the extent that they have more of an appetite, it may simply be because it's a recent startup and they haven't employed their capital yet in writing as much insurance as somebody else might write with the same capital who's been at it for decades. So they may have a little more freedom to be more aggressive on the asset side. In that case, it's more of a closed-end fund than it is an insurance company until they get the insurance underwriting up to scale.
To come back again to some of the things we've discussed when it comes to the crisis in Europe and some of the macroeconomic backdrop, what really keeps you up at night then, and what are you worried most in this environment?
We are watching closely the development of the unintended consequences. The more unconventional central banks become, the greater the possibility of unintended consequences. And as I mentioned briefly, we may not have seen the end of the development of the definition of unconventional. To the extent that quantitative easings, or whatever you want to call it, have diminishing returns, and delevering of all of this debt accumulation takes a very long time with slow GDP growth, then the pressure to do something different grows. And the more it grows, the more the possibility of unintended consequences. The obvious unintended consequence. So if you think about what happened in the 1930s, which was the last major deflationary shock in the American financial system, the Federal Reserve, it's now pretty well understood. People like Milton Friedman and Anna Schwartz and Alan Meltzer have written about this at some length. The Federal Reserve pretty much sat on its hands when they should have been activists. And rather remarkably, in retrospect, they were worried about inflation. Believe it or not, they were actually worried about inflation. And today we have the opposite situation. We have Ian Ben Bernanke, a chairman who in part made his academic reputation as a researcher of the Great Depression. And he is committed to not making that same mistake. So the obvious question that occurs to a student of history is, will he make a different mistake? Will the unintended consequences be in the opposite direction? With the accumulation of bank reserves that we've had, and the fact that aside from Europe, we're on a country-by-country paper money system. And the euro itself is a paper money system. It's just that we have this monetary union that constrains the behavior of the more troubled countries. But the long-term track record of paper money systems is inflation. So if you had to pick a candidate for unintended consequence, it's at some point a re-engagement of the credit multiplier and rising inflation. And then the question is, can they react fast enough? Does the unemployment rate come down fast enough to allow them to respond to that? As yet, as Bernanke said many times, inflation expectations seem to be pretty well behaved. So this may appear to be premature, but if we know that at the current Fed inflation target and a 1.5% yield, the 10-year Treasury has 50 basis points of negative return built in at a 2% inflation rate, what's that going to look like, and what does that do to an insurance company if that inflation rate were to tick up? Because the insurance industry is probably more exposed to rising inflation than just about any business on the planet, because it affects negatively both their bond portfolio, which is the majority of their assets, and in many cases it may affect their liabilities because of claims inflation. The 1970s were a tough period for the insurance industry for that reason, and a recurrence of accelerating inflation would have the same effect. Now, we're some distance, certainly, from a 1970s kind of inflation, but from these nominal bond yields, you don't need much of an uptick in inflation to get pretty unpleasant results. So we're watching the inflation expectations, and the 10-year break-even inflation expectations built into the bond market have an upward tendency here. They are quite stubborn in going down. So the market may be starting to figure this out. Our guess is that Bernanke is going to be somewhat careful about being too liberal until the pressure builds up, or you get a significant drop in inflation expectations from here. So we're very much aware of the potential for unintended consequences. At the same time, we're interested in how unconventional monetary policy has to get. Evans from Chicago, for example, has suggested raising the inflation target to 3% until unemployment falls below 7%. Another idea that's been mooted is for the Fed to set a nominal GDP growth target. that might be a way of tacitly increasing their inflation target for some period of time until real GDP growth picks back up again, assuming that it does. So these are all things that are out there on the horizon, but at current bond yields, there's zero margin for error. And so we're attentive to some of these sources of risk. But the one thing we're pretty sure of is that down the road there are going to be unintended consequences. The Fed has been quick to say that they'll know what to do and they'll do it when the time comes. Williams from San Francisco has said people underappreciate the role of they're paying interest on excess reserves, and that they can use that to manage things. We'll see. There's nothing about interest on excess reserves that's different from what the Fed has done in the past in raising rates. The question is not whether they can raise rates. The point that Williams made. The real issue is when will they do so and by how much, if they need to. The flip side of it is that if there is a banana peel out there and we have not resolved the question of lender of last resort, which we've not, the crisis, as I mentioned before, only confused the issue of lender of last resort rather than clarify it. Is there the possibility of another deflationary policy mistake under those circumstances? And then you're in the wilderness for a long time. So our guess is that it's either another deflationary policy mistake or the unintended consequence of rising inflation, and we just have to make that call as we go along. I think a fearless forecast, a single point forecast is in having to bet real money for real clients, it's too early for that.
Now, some investors have looked to gold both as a protection against inflation as well as against deflation. Can an insurance company, P&C or life insurer, can they even invest in gold? How does
well,
that
to the extent they have the capacity for equity type risk, and particularly for alternative investment type risk, they can. I mean, they can buy ETFs, they could buy gold mining stocks, they could even put it in the vault. It would clearly be an unconventional investment, and we know that over the long term, gold is a lousy investment. It sits in the vault and charges you money, so that as an investment, it has a negative net present value to the extent of the present value of executory costs. It's worth more hanging around somebody's neck in the form of jewelry over the long term, because it's so that you could think of that as a consumption good, perhaps. It's then scrappable if you want to raise cash. But gold is a bet on the government response, which is why it's doing well, and that's why I made the point briefly before we had this unusual situation of secular bull markets in two unlikely traveling companions in bonds and gold. That's an anomaly, and that has to be resolved somehow. One of those has to be wrong. My guess is it's bonds, but we'll see.
And with that thinking, can you give us some sense of every insurance company is different, but what it means then? What is a prudent insurance company doing on the asset side today?
They're being frustrated. I get this question from people all the time. You know, I get this question from insurance companies out there all the time. They say, well, there must be something. There must be something else for us to do. Well, there is. You can take more risk, but everybody else is fishing from the same pond. There's no magic wand. I mean, everybody else is faced with the same yield curve, faced with the same credit spreads, faced with the same issues. There's no magic. The only way to have an edge is, as I said before, have a management and a management culture that takes the view that you want to know when to say no, which is when everybody else is taking risk most of the time. and then wait for your moment. If you have a culture and a management discipline, which probably means a compensation scheme to complement that promotes that kind of behavior, then you potentially have an edge. Because so many compensation schemes and cultures are wired to how do we make our numbers this quarter, that companies shoot themselves in the foot over time with that. The way to have an edge is to have a management culture together with a supporting incentive scheme to differentiate yourself. Because in a commodity business, the number of ways to differentiate yourself is limited. But in the insurance business, culture matters. In the cement business, commodity business, if you have the low-cost factory, that's your competitive advantage. In the insurance business, it's as in financial services in general, it's a management and a culture issue.
And to tie that to another element, which is this, and we see that quite often, and that trend has become even more exaggerated between the short term and the long term. And insurance companies with good equity capital bases, they have that ability to think and execute more long term. Is that also a critical edge?
It is. It is. I mean, there's a compound interest of virtue and a compound interest of sin. The compound interest of virtue is that if you're well capitalized and you have a management culture that is aware of all of this, then the capital over time your capital position has a tendency to strengthen, and you tend to gain competitive advantage relative to your competition. If you are in a weak position, or you to begin with, or you place yourself there by the decisions that you make, then you will continually concede competitive ground to the competition, and the pressure then to stretch gets greater with every cycle, with every year that goes by, and we see both.
At the risk of again being too general about it, that would imply in a sense that for an equity investor looking at insurance companies, sometimes it may be better to perhaps pay a book value or even a premium to book value rather than go for the lowest discount to book when thinking about the rewards and risks of an investment. How would you...
If it's selling at a low price to book ratio, there's a reason. You're not the only guy who's looked at it, and there's a reason. It's not inconceivable that it can be a bargain, and a management change perhaps can turn it around. But the odds are it's selling there because the company has some baggage. And the problem in the insurance business, again, depending upon what line you're in, is that the sins of the fathers are visited on the sons. You carry mistakes with you within your liability book for a long time, depending upon the length of your liabilities. But you can't carry them with you for a long time. So there are ways of analyzing it. You can analyze their reserve development and over time and so forth. But it's definitely true that over time, companies with competitive advantage win, and the market is, to the extent they have competitive advantages, and the market figures that out and awards them higher valuations. So again, when you say no, the answer is most of the time. There will be times when good companies are put on sale, and that's when you want to buy them. So those companies that buying the rock bottom book value, the discount to book value, we'd advise people to wait for those times when the company that doesn't trade at a rock bottom price to book is put on sale because everybody's hair is on fire and they're selling stocks on a distressed basis. That's probably the best investment strategy over time.
Could that be applied to Europe now? Is that a good fishing pond for?
Europe is there may be specific opportunities. We have been looking in Europe, and the problem is, if you look at a lot of companies in Italy and Spain, the German market really hasn't done that badly. The markets that are really on the discount counter are Italy and Spain. The problem is in looking for really good companies. A lot of we look a lot at return on capital, and a lot of their returns on capital aren't very good. A lot of them just aren't particularly great companies. There are some competitively advantaged companies, but not a lot of them. The Italian set of companies, certainly the Spanish set of companies, doesn't look like the German set of companies. Doesn't look like the U.S. It's hard for them with their unit labor costs, with their ownership structures, with their management cultures. They just don't generate the returns. So we haven't been particularly successful in finding a lot of opportunities over there, to our disappointment, because with this kind of stress, probably an approach to those markets is just a generic approach. And since Draghi spoke a few days ago, they've obviously had a significant bounce. We'll see how they make out, but we've been disappointed at not being able to come up with more ideas.
Can you talk a little bit about the insurance space in Europe as a source of opportunities?
Yeah, the big insurance companies, I think I'd say pretty much the same thing. It's episodic. The returns on a lot of big insurance companies on both sides of the pond are such that you, by returns I mean return on capital, you just want to be selective on price, because it's tough to find companies that really outperform sustainably over a long period of time. So we tend to, if we were to buy those, it would be just when the market gets some sort of thunderclap and things are on the bargain counter.
Now, what advice do you have to people who are interested in the insurance industry and would like to learn more about it? A lot of investors tend to dismiss it. It's a black box and don't really make the effort to go beyond and understand it. You have more than 100 clients, insurance companies all over the world. What are perhaps some, everybody knows, of course, Warren Buffett at Berkshire or Tom Gaynor at Merkel. What are perhaps some of the lesser well-known but just as good management teams in the industry, or just businesses that one should study and pick up an annual report? Can you share with us? You talked about the importance of management and the culture. What are some of the companies that one?
Well, I have to be careful, because I live in a very compliance-constrained environment, and they don't like me saying things that can be construed as a recommendation. So I think I'm going to have to pass on that in specific terms. I think what I'd just say generally is that there are companies that have demonstrated some competitive advantage over a long period of time, and those are really the ones to look at. Get to know the companies, analyze the reserves. The data is there to analyze the reserves to a degree. I mean, to some extent, all financial institutions are black boxes, but there is data on the reserves to analyze. You can get a sense that way, and then get a sense of management. But I can't be specific. I'm sorry.
When it comes to the reserves, what do you look at? What's the first thing to look at?
Well, the development in their reserves over time. How have they, by development, they refer to the reserves that they put up over time, and then how things actually turn out relative to the reserves. Because again, the defining feature of the business is that you don't know the cost of the product when you set the price. You have to guess. That guess is embodied in the loss reserves. So then the question is, how do the loss reserves develop or turn out relative to actual claims as they come in over time. And then you can get a sense of whether a company is conservative in its reserves or not. A company that's been conservative in its reserves has probably the kind of management and culture that I was talking about, and that's an important thing to look for.
On that note, John, thank you so much for your
My pleasure.
time and all
Thank you.
the insights.